But let's now look at the negative impact this repo rate increase, the interest rate hike, is going to have on our pockets and everyday spending. Personal finance columnist Maya Fischer-French joining us. Maya, good afternoon. Thank you very much for your time. You are one of those many voices, of course, who's not surprised. You've been expecting a 25 basis point increase or an increase. So what does it mean for you and me, just the ordinary citizens in our pockets? Where is it going to hit us?
Well, Daniel, I'm going to assume that many people are actually borrowing money, right? So I suppose we seem to forget that there are also people who deposit money. So the depositors, the people who invest money and save money, especially pensioners, are actually going to be really, really happy to hear that we are now in an increasing interest rate environment. Because remember, they actually saw about a 30% drop in their income with those aggressive interest rate cuts that we saw with the pandemic. So I think what's good for one is not always good. What's good for one is not always good for the other. So obviously, for those of you out there who have mortgages like myself, car finance, credit cards, well, this just means they're all going to become more expensive. And I think the point that Kevin Lings was making is very important to say this is gradual, right? We're going to see this coming through every second month, every third month. We'll see this little 25 basis points. We're going to get a little bit adjusted up, a little bit adjusted up. But really, the economists are saying this is going to continue probably for 2 years, and they're expecting up to about 200 basis point increase over the next 2 years. So eventually that's going to start to really, really hurt our pocket. And we need to start making, decisions about our debt and about our finances with that in mind. So I think if you are about to buy a home or a car or enter any finance contract, build in these increases as part of your affordability, especially if you're buying a mortgage, you're going to be taking out a mortgage. Just say, right, when this mortgage goes up, another sort of 100, 150 basis points, how can I absorb that? Will I be able to afford it? And for those people who already are with the mortgage, we've got to start looking at where we can cut back to make sure we can maintain those repayments.
Yeah, credit is going to cost us more, your bonds, as you said, and your car repayments. But it's also a good time to think about if you can manage to save more. As you've said, if you've got a retirement, I know you are smiling now because the interest rates are high. So if you could use this opportunity and looking ahead of the next year to two, you could maybe try and save a little bit more, though you're going to get more interest.
Absolutely.
Yeah. So Maya, the other thing that people know, because of the bond, many of us still have mortgages that we're paying off. Some people will say maybe it's time for me to go to the bank and negotiate a fixed interest rate. Is that a good thing, Maya?
No. You're basically betting against the bank. So if you go now and just do the exercise, go to the bank and say, right, I'm currently paying maybe 7% on my mortgage. What would you charge me to fix my mortgage for the next 2 years? And they'll probably come with a figure closer to 9%. Because what they're saying is, we believe interest rates are going to go up, so we're actually going to fix it at a higher rate. It's almost exactly the same if you went to fix your deposit. So if you go and you fix your money for 2 or 3 years, you're going to get a higher interest rate from the bank for taking out a fixed deposit than you would on call money. So it's a similar kind of principle. So, and the thing is that means from day one, you're going to be paying that higher interest rate, even though this is going to be a very gradual process. What I would rather suggest is if you've got the money to be able to pay in a bit extra into your mortgage now, rather start doing that so that you're absorbing those future interest rate increases. You know that you can absorb them, and whilst they're still incrementally increasing, the additional payment that you're paying in at the moment will actually be going to settle your capital. I think that would be a far more sensible idea than going and trying and fixing your mortgage and paying immediately a much higher percentage.
Yeah, Maya, before you go, I know you're pressed for time. What would be the worst thing to do now? Just generally, with the news that the repo rate is up today and that over the next year to two, it's going to be gradually going up.
Well, obviously taking on more debt. So obviously there's good debt and there's bad debt. And the good debt is you're looking to buy a home, absolutely. That's just part of life, right? Interest rates. You're buying a home, just make sure you're factoring in these rate increases. But really, if you're looking at taking out personal loans, any consumer type of debt, this is definitely not the time to be doing it. In fact, now is the time to be paying off your short-term debt as quickly as possible.